Good morning, everyone. And for those who are listening later, very warm welcome. My name is Lisa Correlson. I'm the Chief Executive of Canterbury's Business Improvement District, and joined today by Rachel Pillard, who's our Marketing and Communications Manager. And delivering today's webinar is Simon Ludden, who is the Managing Director of Tarvos Wealth, and is going to talk to us today about the financial climate and how it affects all of us now. And so we've been running a series of seminars throughout this crisis, but also before that. We've just moved them all to Zoom. And if you've missed any of them, you can catch up on the recordings on our website. That's canterburybid.co.uk. So we've done sessions on digital marketing, on Instagram. We've done sessions on business rates and business support. We've done some sessions with Digital Beans, a marketing agency, and they've come up with a free marketing platform called yourlocal.delivery. Also, we've worked with Produced in Kent on Help Kent Buy Local. There's loads of information you can get from our website about the training events we've run, about how we're supporting businesses locally. And I'll mention a few more things at the end about how we can work together on that. But now I will hand over to Rachel, who is going to just talk us through quickly how this webinar is going to work. And then we'll hand over to Simon.
Hello, everybody. Thank you, Lisa. Thank you so much for joining us today. This is really, I'm sure most of you are very comfortable with Zoom by now, but if not, just to explain, at the bottom of your screen, you will see that there is a Q&A button. We would like you to give us as many questions as possible. I'm saying that, Simon, I hope you don't mind. We will encourage questions. Simon, throughout the presentation, that he will ask for questions at certain moments. So if you have any questions for him, please put them in the Q&A section at the bottom, and either myself or Lisa will be able to read those out. You are all on silent. If Simon needs a bit more information from you, we can actually put the audio on for you to have that conversation with him as well. We're expecting that the presentation will take about 45 minutes, and after that, we will have an open time for more Q&As with Simon. So keep the questions coming, and we will do everything we can. I know that you've all found the wave button now, so I'm not going to ask you to wave again, but it's lovely to see you all here. And now it's time for me to pass over to Simon.
Okay. All right, I need to minimize you guys. Just all covering up the presentation at the moment. There we go. Right, let's put that. Okay, first thing to do is to thank Lisa and Rachel for putting these on, because I think they're a great initiative, quite honestly, because we're all trying to keep our businesses going as well as we can, but it's very difficult to meet people now. And I think these sort of Zoom conferences, webinars, whatever you want to call them, are just a good way of keeping communication going. I did mention to Rachel and Lisa a minute ago, I wonder how popular they're going to be as hairstyles get worse, as we can't attend hairdressers. I noticed I had an appointment in last Saturday, but there we go. It was quite, when I first put this up, I thought, well, it was a great idea. There's huge amounts of information regarding what's happening from a health perspective, but actually quite limited information about the financial climate and the effect it's having. And of course, that is affecting everyone, as you will go and see. And it's quite interesting putting together, and quite difficult really, as to how to put a seminar together that really hits the button for everyone. So let's see how we get on. I think it's not working. Why is my... That's it.
Have you, Simon, you need to press the share screen.
Again?
Yes, yeah, we haven't got the slideshow at the moment.
Right, okay. Keeps losing that thing. Hang on, I have to go on to you.
Keep, hover the mouse over the bar at the bottom.
Yeah, the bar doesn't come up at the bottom, unfortunately. Good old technology. Hang on, let's have to go.
There we go.
You got it? Okay.
Brilliant.
Right. So I think the first thing to mention is what is going on. Well, we're all aware of COVID-19. I hope not to mention it too much in this presentation. But when you're talking about investments, investment markets, financial situation completely, what we're really talking about when you have what we're effectively moving into a recession now is uncertainty. And I always thought it's quite handy to mention a particular situation to explain why uncertainty causes so much problem. And one of the best illustrations I could think of was back in 1991, where we were moving into the first Gulf War. And for those who remember that, there was an awful lot of diplomatic sort of noise going on, if you like, between the various potential combatants, and that was creating massive amount of uncertainty in the market. As the investment markets continued to fall and were very, very volatile at that point. When the war started, the first shot was fired, the FTSE 100 or the investment markets suddenly shot forward, and that wasn't because they thought war was a good thing, because clearly it isn't. It was because suddenly we knew where we were. We know what we're dealing with now. And all the time you don't know what you're dealing with, investment markets become very volatile, which means ups and downs effectively, and uncertain. And we saw an initial fall in the FTSE 100, but it was almost like a perfect storm, really, because at the same time this was happening, Russia and Saudi Arabia decided that they were going to break away from the OPEC agreements and suddenly produce lots of oil. So they were pumping out oil at a rate of knots. And as we fell into lockdown, clearly the demand for oil has fallen off. So we saw the oil price plummet. So the Brent oil price has gone from about $60 a barrel down to about 20. But very strangely, in America, the oil price in Texas fell to minus $40 a barrel, which I believe is the first time that's ever happened, where production companies were having to pay people to take the oil because there was nowhere to store it. And because oil wasn't being used we weren't heating houses, we weren't driving, etc. Effectively, we had a massive surplus of oil. Now, in the last couple of weeks, the Russians and the Saudis have come back, and they've actually not halted, but cut down on the production of oil considerably, and that has alleviated. But when you put the uncertainty of the COVID virus or coronavirus alongside the problems in the oil market, you have a real issue as far as investment markets are concerned. And then when you think that in the UK, two of the largest companies that are constituents of the UK investment market, which is Shell and BP, they own over 25% of the top 100 companies in the UK, then they were losing value at about 40%, then you see a perfect storm almost. So the FTSE 100 fell frighteningly quickly, as you'll see in the graph I bring in a few minutes. So that inevitably, it will bring us to a world recession. This all sounds pretty miserable, but recessions happen, and they never stay. They happen, we get through them, and we move out the other side. I don't think we will fall into a depression, which is just a very serious and long-term recession. I think what we're looking at is a period where eventually we can see the end of it. So you'll see when I go on to investment markets how this has worked. Initially, investment markets fell very, very quickly and by a large amount. They then bounce back up again as they perhaps over. Like in all these things, people react too quickly, a bit of a knee-jerk reaction sometimes, and they oversell off, and they bounce back quite a lot at the moment, as again you'll see in a minute. So at the moment we're seeing a much more modest sort of movements in the investment markets, and we're seeing a lot more restraint. So hopefully we're over the worst of that, but I suspect we'll see quite a bit of volatility, which again, for those who aren't, and I don't want to sort of get involved in jargon, but who aren't used to the word volatility with investment markets, is really the ups and downs of the stock markets. So we should see a little bit of that, but we are seeing ups as well as downs. So, you know, it looks like we've reached the bottom of it. So what do people do about it? Well, the central banks, the first thing they did was cut interest rates. Now, you may remember that interest rates in the UK were sitting at 0.75, so 0.75%, up till recently. There was an initial cut down to 0.25% and then a further cut to 0.1%. This is what is known as monetary policy. So it's what the Bank of England can do effectively. Now, when interest rates are at 0.75%, one of the problems they had is there's not a lot they can do. There's not a lot of real wriggle room for changing things. So by putting them down to 0.1%, that's about as much as they can do. And that hopefully will add a bit of stimulus. It'll mean that people will pay less on their mortgages. The companies will pay hopefully less on their borrowing, but perhaps more importantly, the government will actually be paying less on their borrowing, which of course they're doing at a massive rate now to fund what they're funding, which we'll go on to in a bit. So overall, it's a good thing, but 0.75 down to 0.1 is not a major move. For example, if we'd been on 3% and we moved down to that, that would have been a much more effective move, but that's all they could do. So this is what markets have done, and they look a bit frightening, I know, but this is a 4-year view. And the deep red one and the blue one are UK markets. So we can see that over the last 4 years, because of the political situation, obviously regarding Brexit, I don't want to mention that too much either, we have lagged behind the rest of the world. There's no doubt about that. Again, the uncertainty, which I talked about earlier, has meant that we've been lagged behind. And we saw a big dip in sort of February, March, and it bottomed out on about the 23rd of March. And you can see there that the markets have come up since. Nowhere near where they were, but they're showing much more confidence in what's going on. There's a bit more knowledge about the fact how the governments are protecting the industry, etc., both in the US and in the UK. So we've seen a decent bounce, and in the last 2 or 3 weeks, we've seen markets more or less running between a balance of about 5,500 and 5,750, something like that. So they're trading in a quite tight range now, which is a generally good thing, I think. So you may be asking, why does this affect me? Well, it affects pretty well everyone, but in different ways. And I think, and I don't want to be political, but I think it's had a polarizing effect, because there's been a lot of comment in the last 10, 12 years since the credit crunch crisis that there's been a distancing between the haves and the have-nots. And I think this hasn't helped, in that in some ways it's created a little bit of, it's exacerbated the issue a little bit, because it will affect everyone. Everyone who's working now has a pension plan. If you have a pension plan, your money is in investments like we've just seen. But the important thing to realise that if you're in a pension plan, then your money is in a wide range of different investments. So we talk there about the FTSE 100, which is the top 100 companies in the UK. We talked about the world index markets, which are equities. But your investments won't all be in equities. They'll be spread across a wide range of different types of investment. And the younger you are, the more will probably be in equities, because with the workplace pensions that most people are in now, they're in what they call lifestyle funds, which means that they're more aggressive the further away you are from retirement, but as you get closer to retirement, they become more conservative, moving into lower risk investments. So the reason I say it's got a polarizing effect rather, is because a lot of people are worse off because of this, but there are quite a few people who are better off. But I'll come on to that in a minute. But going back to pensions, which we are all involved in some way or other, I've slipped into jargon here, but I'll explain it. DC, now that stands for Defined Contribution Schemes, and that's the type of pension that most of us are in. So if you're in a workplace pension, which has been set up in the last few years, you've got a personal pension, that is a defined contribution pension scheme. That means you're building up a pot of money which you will then use to help your retirement when you eventually finish work. That's the idea of it. At the moment, you can draw those at age 55. Now, they have been directly affected by the current crisis because they will be invested across a range of investments, as I mentioned. So anything that's been put into the stock market will have gone down in value, but also not only the stock market has fallen, but other types of investments like fixed interest, which I don't want to go into here, have also fallen. So the only things that really went up during the initial crisis were gold and government gilts. So we have been affected. But if you're putting into a pension scheme, then what you're doing is you're putting money in at a much lower level than you were putting it in 2 months ago. So it's very important that where you can, you continue making those contributions. So those contributions you're making now will have far more value going forward than your contribution you put in 2 months ago when you were buying less for your money. So it's very important you continue those if you possibly can. And going on to the furlough later on, which obviously a lot of people are involved in, the company will be required to also continue their contribution to your pension. So that's worth considering. DB stands for Defined Benefit Schemes. Now, these are what traditionally people call final salary type arrangements. And around this area, a lot of people in the universities, NHS, teachers, etc., will be in defined benefit schemes. It doesn't make any difference. The current crisis doesn't make any difference to NHS, apart from the fact, of course, they're doing a wonderful job themselves, and I'm quite glad it's not affecting them. But it will affect people who are in university schemes, for example. So they still get their guaranteed pension if they're in the defined benefit or final salary arrangement. I know the new scheme isn't defined benefit, but those people who've been there a long time will still be benefiting from final salary type arrangements. But the universities will find this difficult because what they've seen is their investments, which run the scheme and pay for the benefits, will have actually gone down in value. But also, the amount that it costs to buy those benefits when people retire will have gone up. So it's a bit of a double whammy for those types of schemes. It's really a double hit, if you like. That may change as things improve, of course, but that's where we are at the moment. So the university scheme, which is already showing a big black hole, a big deficit, will probably show a much bigger deficit by the time this is all over. So they have been affected, but it is important, as I said a minute ago, if you're paying into pensions, keep doing it, because what you're doing, you're buying units at a much better value now than you were 2 months ago. So this is an important time to continue if you can do so. Mortgages, obviously, if you the cut in interest rate will help people pay mortgages, and I'll go on to do a section on mortgages later on, so I won't spend too much time on that. But in a strange way, as I say, some of us are actually better off, and that's because many of us are working from home. We're not traveling into work, we're not going out to restaurants, cinemas, theatres, whatever. We're not going on holiday, so we're not spending money, and we're still working for many of us. Those that aren't, obviously it's very difficult, and those who've been furloughed will still be getting a reasonable most of their money, but some of us are actually better off. And this could be a good time to start paying off debt or actually investing money over a period of time. So putting money into regular investments, ISAs or something like that. So I wonder if people are actually thinking that. They're thinking, oh, I'm working from home. And I've talked to quite a few people about this, and they're going, so are you better off? They said, well, funny enough, we are. You know, both of us are working still, working from home. We're not paying out on anything. Well, great time to start paying off your debt or start investing into an ISA or something like that. So just something to think about. So I mentioned earlier monetary policy, which is what the Bank of England has done, and the Fed in the United States, cutting interest rates, etc. So what the government do is what they call fiscal policy. So you might hear this mentioned on some of the economic programs, monetary policy and fiscal policy. So fiscal policy is, its definition here refers to the use of government spending and tax policies to influence economic conditions. So if you think of interest rates, monetary policy, tax and economic policies, government fiscal policy. This is quite an interesting one actually, the 330 billion, the government-backed loans and guarantees. Well, up to now, they've been backing 80% of the loans, yet the banks weren't really playing ball and they were still holding back because of the 20% that they were covering themselves. So my understanding is that last night they've actually agreed that they will now cover 100% of all loans to companies, and they will also try to get the money out much quicker than it has been. I think it's been bogged down in red tape, the amount of information that's required, etc. But because the government are backing them, I understand they're going to get these through much quicker now. It's one of the criticisms of this government compared to, I believe, the US government, which actually got money out to companies very quickly. Over here, we've lagged a little bit on this, I think. So those companies that are looking to borrow money, now's the time to do it. There may not be a better chance at these current interest rates and with the government actually providing the backing. So the rate you should get would be much more attractive than maybe if you'd gone at a different time. Business interruption loan schemes for smaller businesses of up to £5 million each. This is businesses up to 5 million, not how much they're lending, the size of the business. Worth checking insurance policies on this. We actually checked our own policy, though we're very much still trading and all still working, though mainly from home, of course, though I'm actually in my office this morning. But I noticed on our insurance policy, we have a business interruption clause in there. So look through your business protection policies just to check whether you've actually got that clause in there, because that could be a very useful backup to you. And of course, you wouldn't be alone if you got it through insurance. It would actually be a payment. So there we go. There are also £25,000 cash grants, which are available for smaller businesses who don't have insurance. So again, you need to apply for those. So I'll show the website in a minute. And there's also these £10,000 cash grants. Now, these are available for the smallest of firms, so family-run type of businesses, small limited companies generally. I know up to a couple of weeks ago, 9,000 of these had been paid in Kent alone. Generally, if you were a company that applied for business rates relief in the last year or two, you would have got this automatically. You would have just got it to your bank account. It may not sound a huge amount of money in the context of running a business, but I'm sure for some businesses, it could be the difference between survival or not. So the fact that money got out very quickly, I think, was actually quite impressive. Three-month mortgage holiday is more about individuals on the whole, though I understand that when I go into mortgages generally, that loans are probably being more open to this as well. So all main mortgage lenders should be providing a 3-month mortgage holiday for those that need them. I'll go into explain later on, but just bear in mind it's a 3-month holiday. It's not a free period, if you like. So that interest will be loaded on at the end. So if you don't need it, maybe don't necessarily take it. And going back to my previous slide, then this could be a good time to actually pay a bit more on your mortgage for a while if you are one of those lucky people that's actually find yourselves a bit better off. Maybe a good time to see if there's any questions at this point, Rachel.
Thanks, Simon. Yes, we have had 3 questions through. So, the first one, excuse me. What is your opinion on the financial climate for promoting legacy giving?
I think, yeah, it's interesting. I know where that's come from. I think legacy giving is huge for charities, and you look at the big charities out, the heart charities. Even I remember one I got involved with, the guy who ran it, with Guide Dogs for the Blind. A huge amount of the money they've built up over the years, tens of millions of pounds, has been from legacies. And I'm not sure that it will be any worse now than it was before, because I think, yes, people who invested will look at it and think, well, I've actually lost money. But ultimately, legacy charities are coming from people who give money to the charity in their will, legacy giving. So I don't think they'll be affected. And in fact, I think it's quite a good idea to get the message out now. I know this is something that's probably come from Deborah, I presume, is it? Yeah. And Deborah and I were working on this because, you know, for Porchlight, it'll be, I think, it could be a major thing that would see them through as a major charity in future.
Mm. And we have representatives of both Porchlight and Catching Lives here today, so that could be very relevant for both of them.
Relevant, both of them.
Yeah.
And I know both, you know, at the moment they work on the grants they receive and the gifts they receive. But if you can build up a panel of legacy money, I think it makes charities so much stronger going forward. I mean, we look after one or two charities here where they have, you know, where just the money that's been given, they just take the income from it, and that money stays there and keeps the charities solid for years to come. And that's how the big charities build up. So I don't think it'll be affected in many ways, because the thing about legacy giving is very much people looking to the future and actually putting a proportion of their will giving to the charity. So I think it's not a bad time when people are thinking about money to actually start mentioning these things and maybe get something out.
Thank you. Second question, this is about personal pensions. Should I increase my contribution as I approach retirement? I am 60 at the moment, but don't have a planned retirement date yet.
I think so. I mean, though it's shutting the stable door, it's the money you put in early obviously has more effect because it has longer time to grow. But generally, we're usually in a better financial position as we get closer to retirement, so we can afford to do so. Pensions are still probably the best way of saving for retirement, but I always think it's not a bad idea to mix ISAs in there as well.
Well, this is the third question actually. So ISA investment.
Yeah.
Would you recommend a low, medium risk, regular ISA investment? Considering this is from the same person. I'm not going to say her name because.
But given this, that's 50% counted out. So.
Yeah. Would you recommend a low, medium risk, regular ISA investment considering my age at 60? And should I look at my total £20,000 allowance?
Yeah, I mean, it's something we do an awful lot of. And when we're planning for retirement, generally what we do is we try to mix ISAs and pensions depending what's required. Pensions give you tax relief at source, and that's very attractive. ISAs don't give you tax relief at source, but they provide tax-free income. So when you retire, what you need most of is income. So having a mix of the two works usually very well. And as I said earlier, if you're in a position to do so, it's an ideal time to start putting money into investment ISAs, particularly stocks and shares ISAs they call them, because you're buying very low. And I've had people say to me in the past, well, I'll wait till the market goes up before I buy. It's a bit like if you're buying a pair of shoes in a sale, would you wait till the price goes back up again before you bought them? Well, you probably wouldn't. You'd rather buy them when they're cheap, and markets are now quite cheap. So the answer to that is, yeah, good time to do it.
Brilliant. Thank you very much. Okay, you have answered all the questions.
Okay, thank you. So there's one more, actually, the business rate holiday, which I forgot about, which we know about anyhow. So there's been quite a bit of action by the governments. I put in here the government website actually as a help, because I don't know, will people have access to these slides if I want? Can you have that? Or you can write this down. But if you're really unsure about anything that the government have done, look at that website. I think it's very good, actually. And you can knock down the various areas exactly, and it's very well written. So, you know, well done the government there, I think. So look that up.
We'll, when we send out the email after this session, I'll make sure that the link's in there as well.
Okay, brilliant, thanks. Okay, so continue on what the government have done. So I thought that was good for businesses. Now, employees, we've got the coronavirus job retention scheme, which is more commonly known as the furlough scheme. And that really has helped businesses. And I don't want to go in because I know David at Girlings did some work. Also, David Morgan, wasn't it? Did the other day on this. But just to let you know and just update it slightly, furloughs allowed companies to put some of their workers on rest, if you like, and have 80% of their wages recovered. So that's brilliant, and I think a lot of companies have used that. And I understand on 20th of April, the first number of companies actually reclaimed their furlough money, which was good. What a lot of people don't realise is that it also includes their national insurance, the employer's national insurance, and workplace pension employer contributions as well. So if you're worried about the fact you've been furloughed and you're not paying into pension, your pension contributions will still be paid from the employer, and they should also be deducting it from the employee as well. So that should still be going in. As I mentioned, that's a good thing. For the higher paid people, there is a maximum of £2,500 a month, but that also, on top of that, is national insurance and pension. So you won't miss out on any contribution into your national insurance or your pension plan. So that's, I thought, just a bit extra I put in. Bit more difficult. These are the people I feel particularly having a very tough time of it. It's the self-employed. The government haven't really, I don't think, grabbed the metal of this one. They're not even looking at the self-employed until mid-May, but there's a lot of self-employed people out there. They could be plumbers, roofers, electricians, etc. But also in all sorts of businesses, people are running as self-employed. And many of those, their contracts have just finished, just like that. And they're getting nothing. I know this from, well, my own son, for example. And he's a plumber, and all his contracts just stopped, just like that. So they all have families to feed and everything else. Yet they're not even being looked at till mid-May. And if you go onto the website I mentioned earlier and you look through what they're required to supply, it is very tough. And I think that's a very difficult area. It's going to be the self-employed. It's a personal view, but they won't even get any help until June. So in the meantime, they'll have spent what, two months plus potentially with no money, no work. So that's something to think about. As I said, last Monday, the furlough payments started. The first 30 minutes, there were 67,000 applicants. According to HMRC, the revenue, their systems can do 450,000 applications an hour, which is quite impressive if it stands up. I've not heard that it's fallen over yet. Someone may actually tell me differently, but I understand. So that's actually quite good. The CEO has announced that, there we go, this is what they say, that they capacity to do that. And they reckon that employers will have their money within 10 days. So that actually is quite impressive. So I think that's quite good. This is something that's a little bit more concerning, is that, and I've even seen evidence of myself, they are concerned about the risk of fraud, and they will be making people, putting people around to check on fraud. So there will be random checks on companies, and even small things. For example, I heard an example the other day where a member of staff had been furloughed, and his bosses asked him to come in and do some work. Well, one of the clear instructions on furlough: you don't work. If you want the government to pay your staff, they can't work for you. So the revenue are ahead of the game already. They are aware of this, and they've appointed people to check into this. So please, as a company, don't break the rules on that. So they're looking at fake employees, and people ask me to work on the quiet by employers. I'm sure there's going to be some of that. I'm sure there's going to be some of that. And also they'll be asking employees to whistleblow, but you sort of feel, well, why would they? But we will no doubt get more of this in due course. And hopefully it won't be too much of a problem. So what should you do in the current climate? Well, for those who've got investments, so we mentioned people who may have ISAs and pensions at the moment, should you move out of those investments? Well, so it's a question we've asked. I mean, what we've done throughout this crisis is every week we send out a new text to our clients make sure they're up to date with what's going on. And the most important thing we as advisors can do is provide people with information and just keep them in, let them know we're around, speak to them on the phone. I had a major Zoom conversation with one of my clients yesterday who was quite panicky about things and needed to have things put in context for them. And our advice on this is the worst time possible to move out of investments. You saw my slide earlier. You can see that markets have gone down, which means your investments have fallen. Again, why would you sell at a low? Let them recover. They've started to recover a bit. There's still going to be more ups and downs, but they have started to recover. This is the worst time you can pull out of investments. So if you can avoid it, and we appreciate that some people will, you should avoid doing that. Also a good time to put more money in, and particularly if you're going to do it on savings, do it with regular savings. But for many people, cash is important at the moment. It's important for businesses. And I don't like saying it, and I mentioned about putting money into pensions, but for businesses, if they tend to put in lump sums into their pensions, and they normally do it about this time of year, this might be one of the few times I would say, well, perhaps don't do it, unless you're sure of your business and you're sure of how you're going to come out of this, because cash is going to be important. There are loans available. We've seen the grants already, but cash is important. Maybe just defer that a little bit, because there'll always be the opportunity to catch up later on. And that rather goes against what I said earlier about putting money into pensions, but sometimes it's just a matter of making sure the business survives. And I wouldn't encourage someone to put in money into pensions if there's a risk of the business going down because of this. So cash is key. When you withdraw money from investments, people like to look at their investments, and some people look at them too often, I think. When they go down, is this really a loss? Well, until you actually take the money out, it isn't. Really, you can look at it as it's a paper loss, but the actual physical loss of your investment is not at that point. It's when you take it out, then you crystallize that loss. So then it becomes a true loss. So at the moment, we've seen the market bottomed at 23rd of March, I think it was, and it's now sort of come up somewhere since then. Still a long way to go, but better to put money in than take it out at this point. Banks and building societies, a lot of people go into 1-2 year bonds with banks and building societies. At the moment, they're offering penalty-free withdrawals. So if money is important, then that's a good place to take it from. Often people won't take out of their fixed term accounts because they're worried about penalties. Well, you can approach your bank and building society, and in many cases, they will let that go through penalty-free. And as I mentioned earlier, potentially a good time to invest with prices low. And you'll see the deposit rates are likely to fall lower. They've been drifting down, anticipating further rate cuts for a while now, actually, not just because of the crisis that rather hurried it up. So though you can still get 1% on some deposits in some areas, I expect that's going to be fewer and far between, and there'll be more and more maybe penalties. You'll be tied into deals, restrictions on doing that. So it's difficult, as it has been for a long time, to get decent returns on the high street. When we talk about mortgages, how am I doing for time? Okay. I want to thank Robin Davis, who is one of the guys we use. We don't actually provide advice on mortgages ourselves, so we have a couple of consultants we bring in, and one of Robin Davis has helped with that, and I'll give you his details for people who want to do that. As I mentioned earlier, there's a 3-month respite for people who are paying mortgages at the moment. Also, they're looking at doing the same for buy-to-let mortgages, so people who are obviously buying properties they're letting out. So again, you should be able to approach your lender and ask them for a 3-month holiday if that's necessary. And most importantly, because some people worry about this, it won't affect your credit score, and this has been confirmed by lenders and credit reference agencies. So it's not like you've missed payments or anything like that. And also, it won't affect your ability to change rate with lenders should you be close to the end of a fixed or preferential rate. So it won't actually stop that happening. So again, it's all quite good news as far as this is concerned. But I do say, if you don't need a payment holiday, don't take one. If you need it, yeah, by all means use it, because it's so important to keep things going. If you don't need it, then it's a good thing, because otherwise interest will just be added on at the end. So you'll be paying a mortgage a bit longer anyhow. You don't actually get it. It's not free money. For new customers, there's plenty of lenders out there, but as we probably know, the housing market is somewhat seized up. Estate agents are not trading properly. They can't do visits to properties, and surveyors can't go round to visit properties to value them either. So it's been a bit of a difficult point, albeit there is money there to go and lend at very good rates. Where you're buying or selling a property which is maybe part of a, say, an estate where there's similar properties around, they're actually looking at more automated models of valuation rather than the physical sort of going around and stamping on floorboards and things like that. So that's actually helping, but it's still quite difficult. And what's not helping is that the lenders are not offering higher loan to value products at the moment. So it's because of the lack of a physical valuation, sometimes they're being a bit restrictive on the amount they will lend against the value you're buying. So that's not helping either. It's quite a difficult housing market out there. And if you have managed to sell or buy a house recently, well, I think you've done well. I think they're going to start looking even more closely at sustainability of income, especially for the self-employed. Again, it's a bit of a down on the self-employed, this, unfortunately. And also employees with variable income sources, so where they're getting a lot of overtime bonuses. So they're going to be more concerned about that, and they're going to require more evidence, no doubt. Is there any questions about that? Sort of rather race through that a little bit, because I know you're on for time.
No, there are no questions, so you're welcome to continue.
Okay. So I mentioned the lower of the Bank of England base rate, 2.1%. If you're lucky enough to have an existing tracker mortgage, that's good news, because your tracker will then be based on whatever percentage it is over bank base rate plus the point, plus whatever your rate is. So plus the 1.1%. So that's going to bring your mortgage payments down a lot. And again, if you're one of those fortunate people who have, you know, your income is in a good position, this may be a good time to continue paying at the rate you were paying before, if that was comfortable, because you'll be paying off your mortgage quicker. Okay, so fixed rates, but not on fixed rate mortgages, probably not too many changes we expect here. Maybe a little bit of competitive pricing, but not too much. They're already quite attractive fixed rate mortgages at the moment. Commercial lending, pretty well the same. I talked about the business interruption loan scheme, etc. Worth looking at now, particularly now the government's prepared to back 100%. So that's quite important. Important to get in as quickly as possible, because there will inevitably be a bottleneck. So get your applications in. We know it's quite complicated, but some people have a little bit more time on their hands now. So you can get into that. For that, I put in Robin's contact details. If anyone either wants to come through us or speak to Robin directly, please contact him. Just say where you heard from him.
Thanks, Simon. I'll share those details on the email too, so everyone can click through.
Yeah, no, it's very good. Very easy to talk to, Robin. Things. So, as I say, we have a bit more time on our hands, I mean, for many of us. So we think it's a good time to review things that we're dealing with, which is pension schemes. Most people haven't got a clue where they stand on their pensions. Apparently now, between leaving education and retirement, the average person now has 11 jobs, and with workplace pension schemes, that potentially means they've got 11 pension schemes. And we meet a lot of people who go, I've got all these pension schemes, but I've no idea what they mean, what they're worth, what they mean to me. So good idea, it's a good time to do that, I think. And also a good time to start long-term planning. Just on the pension scheme, there is talk, the government talked about it before, about having like a dashboard where you could go online, use your national insurance number, and it would bring up the pension schemes you have. Hasn't happened, but I have from a very good source in the industry that the pensions companies are looking to put this together in the next year or so, and that will be brilliant for people, where they can actually go, oh, got it. It may not give you full details, but it'll tell you what you've got. Because if you think say you're 60 now, can you remember what your pensions were when you were in your 20s? Most people can't. There's a huge amount of money missing from people's pensions because they just can't remember they've got it, they've moved, changed the name, etc., etc. So good time to start thinking about that, I think, when you've got a bit more time on our hands sometimes, and to start looking at long-term term planning. Investment markets are low, as I said before, so it's a perfect time for regular investing into stocks and shares ISAs if you want to do that, and maybe even take a little bit more risk than you had before because the risk has happened now. So get in low. And we're nearly on the last lap now. So these times of uncertainty probably bring more need for sound financial advice than ever before. And okay, we're in volatile times. I explained what it meant, which is it's the ups and downs of markets. And some people are more at risk than others, and those that are taking money out are more at risk than people who are leaving it in there. And also those people are taking high regular incomes. Obviously that means that income's not being ploughed back into investment. So they're people that probably need to take more advice than people would normally. I think, interesting enough, it's what we've got from people is actually focus the mind on more on what they're spending. Certainly those people are spending more time at home. They're starting to look at what they can do, what they can afford to do. So it's a good time as far as these things are concerned. There are some positives amongst lots of negatives at the moment, which is what we do a lot about it. I think people think about timing the markets. You know, when's the best time to go in? Well, it's a bit of a mug's game, unfortunately. It's important that you're in the market because when markets go up, they go up quite quickly and in very short spurts. So they may go up. There may be 6 major days in a 2-3 year period when they go up considerably. And once they've done it, they've done it. So you need to be in the market to take advantage of those. And again, people who think, oh, I can time the market, well, you try it, you can't. Markets move too quickly. Good time for employing strategies like phasing your money, planning for withdrawals for pensions, etc. Again, good time to start thinking about the strategies going forward, particularly if you're nearing retirement. That's really all I want to say today. I think gone a little, well, no, I've done about right, about 45 minutes. Normal risk warnings, we have to do with these things. And that's me. Okay, I think I was pretty well dead on 45 minutes, really, wasn't it? I think
brilliant, absolutely brilliant.
Hurried a little at the end, a little bit, but obviously people have the slides if they want them.
Thank you. Yeah, if you don't mind, we'll share the slides. We'll share a recording of this as well. And in an email, I'll include all of the links that you've put in your slides so people can access them quickly and easily. A lot of that just rang home so true to me, thinking about just from a personal situation with the number of pensions that I have over the years and the mortgage holiday as well, which I might have happened to have already entered into. Maybe I shouldn't have done. Sorry, Lisa, go ahead.
Yeah.
Well, Simon, thank you so much. We really value these sessions. I'm sure a lot of us are dialing into lots of webinars now, and certainly Rachel and I are, you know, within our industry, place management industry, and a lot of that is about working with other bids and other towns and city centres on how we can lobby for more, you know, business support. And I'll just come on to that in a minute. But I'm just going to mention a few things. But if you think of any questions while I'm mentioning a few concluding remarks, then please feel free to either raise your hand and we can unmute you, or type them into the Q&A. But the reason why we do these webinars is because it's really important to us to stay in touch with you and to see your names and sometimes see your faces. When we're in webinar mode, we can't see your faces, but we do also hold some networking and sector meetings on Zoom. And it's just really important for us to stay in touch with you and to hear from you. And also to all of our webinars are delivered, the training ones, by businesses locally. And that's really important to us. So our next one is coming up on the 6th of May, again, so that's next week, 9 to 10 a.m. And that's on video content for social media. So that Chris Duncan will be with us from Spark Production. And many of you have probably met him or would at least recognize him. You've probably seen him at our networking events or filming. He does a lot of work for people locally. The other thing we've been doing is working a lot with Canterbury City Council. So on the cash grants, different local authorities have done it differently. What Canterbury City Council did was to buy in the software so that they could get the loans out as quickly as possible to everyone. I think there was a little bit of frustration with that initially, because it meant that there wasn't a lot of communication because they were focusing their time on getting the money out. As of the end of last week, 70% of those grants, both the 10,000 and the 25,000, had been distributed. And the reason why people have to apply, as it were, fill in a form, is because they don't have everyone's bank details. So if you, I'm just looking here, and I think we're dealing with some quite high rateable values with people on this call, so it might not be, it might not apply, although I think for some of you with multiple properties it might. Then if you haven't had that sorted, you can go on our website, the council website. There's a dedicated email address for the cash grants, and there's a form that you need to fill out in a particular way, and they're doing daily pay runs. However, the other thing we're involved in is a national campaign that's being led by BIDS called Raise the Bar, because we don't think that the threshold of 51k is right. It's too low. In addition to that, we don't think that the sector breadth, we think it's too narrow and it should be widened. So we're working on that as well. So if you look on our website, there's a news item, or just type in #RaiseTheBar, you can sign that petition, and anyone can sign it. And that is simply to say to government, we need to increase the threshold for the grants. On a more upbeat note, we have just launched a photo competition for all of you, for all of our businesses, because we want to see what lockdown is like for you. So a lot of the photos I've been seeing are these pictures of these Zoom calls where we're all meeting together in a new way. I can't enter the competition because we're running it, but if I were, it would probably either be a photo of bluebells, because I've seen more bluebells over the last few weeks than I have in the last 12 years, or it would be a photo of all the baking I've done with my daughter. Never made shortbread before, but I have now. But it would be lovely just for all of you to enter that competition or to post a photo, and that's on Canterbury Bid's LinkedIn page, and you can get that on my profile. But we'll do some quick links after this. There are a lot of other initiatives that we're working on. Our website is promoting all local businesses who can still operate and deliver, whether that's some retail or food, all sorts of things, and Rachel's keeping that up to date. So as I've been talking, there are a few more questions. So I'll just read those out because we do have a few more minutes. So Simon, thanks for the presentation. Do you have any further advice or signposting you can give on protection for business debts and where to seek the best advice, given there is a focus on loans to sustain businesses? This has come through from quite a few businesses we were talking to yesterday as well.
Well, I mean, finance isn't my speciality. My speciality is more pensions and investment, which is why we bring Robin into that. I think, so what you're looking for is alternative to loans, are you saying?
Let me just, Rachel, should we go ahead and just unmute Claire? There we go. So Rachel, you're on mute, but there, Claire, I think we can hear you now.
Hello, hi.
Hi.
Hello, Simon, thanks for that. It was just really obviously we're all in the situation where we're working out a future plan, and one of the areas is around loans, and we're a charity but we're also a business. So what I'm doing is receiving lots and lots of information about loans, and I think what I want to do is check the risks around anything I take on before I do anything at all, because as good governance dictates, you know, it's to ensure that all of my trustees are happy and confident, and also for financial planning that happens on one side, but the other side is where do we go to, who's the best person to speak to. That was my question. It may not be something, it may be something that your colleague could help with, but I just think it is a really uncertain time, and taking on loans may be something that some businesses do more often than others, but based on a sustainable business, this is not, you know, we spent a lot of time getting out of having a loan to ensure we were sustainable, and now we're back in that situation. So I just want to go through everything in detail before I actually jump off to do anything like that. That's the point.
Well, I think it's certainly worth looking at what the government are backing anyhow, but by all means, I'll have a chat with, for example, Robin, who put the mortgage slide bit together for me, and see what he suggests there. But I mean, there's those opportunities, as Lisa was saying, with the government back things at the moment, and that's probably your best bet. Anything the government are backing is going to be at a better rate probably than you going alone. Yeah.
Okay.
So I would certainly exhaust that first. But if you want, yeah, if you want to sort of, if you're interested, I'll put you in touch with someone that can actually specialise in that area.
Thank you.
Great, thank you. And there's a question from Imogen. Any thoughts about the next 6 months to a year?
Yeah, quite a few actually. I mean, I mentioned uncertainty quite a little bit, and as things become a little bit more certain, at least whether they are or not, I don't know. But you know, you'll see the financial climate improve. My concern is there seems to be a huge swell of opinion and people wanting to go out and do stuff now, and I do worry it's a little bit too early. Interesting enough, I was talking to my daughter who lives in Dubai, and they've lived under quite restrictive lockdown situation for the last few weeks, where they actually have to apply online for any permit to go out at all, and you're only allowed out so many times every, you know, twice a week, every 3 days or something. You're allowed to go out to the get food and meds and that sort of thing. They've turned it round, and it's a bit political because it's probably because of Ramadan, and they've now let just people out in groups of up to 5. And you think, really, you know? As far as that's concerned, I think I'm hoping that we don't leap too quickly into things. But as far as investments are concerned, one thing about investment that's important to know is that the markets look forward. So as soon as they hear good news, they will leap forward. If they think that's going to be good news in 6 months' time, they will go up now. That's why I say it's quite important, if you're putting money into an investment or whatever, to actually start building up while the markets are very low. So from an investment point of view, we know what we'll get out of this. We just don't know quite when, whether it's going to be 2 months, 3 months, 6 months, next year. We don't know that for this moment for sure. And that's where we are at the moment. But the markets are looking for opportunities now, and our investment managers we work with that run our portfolios they're already looking at those opportunities while markets are low, to get into companies that are well run and are looking to take advantage of the markets when they get back again, because they will. It's the nature of everything. It's not like the 2008-9 crisis where everyone thought the banks were going to go bust. The banks are pretty solid, really. So we know that when we get through this coronavirus problem, that things will improve. So it's just a question of when, and obviously that's a health thing, which obviously I can't answer. But I know that there's a lot of positivity and people waiting to put money into investment markets at the moment, and that will push them forward. So as I've said quite a few times on that presentation, if you are thinking about making some savings, good time to do it while markets are low. But as to when, 6 months, don't know. don't know, I wish I could say.
No, none of us have a crystal ball, but we are starting conversations and have already started conversations on recovery planning. We know it's going to be a challenge. We know there's going to be a really long tail on it. It's helpful that we can watch other countries, but we are working with Canterbury City Council, through the Kent Resilience Forum, and also conversations nationally about that. And then most importantly, talking to all of you about what you're seeing, what you're thinking. But Simon, thank you very much for this today. I think it's been really, really helpful. Our sessions up until now have been really focused on training for businesses, but it's nice to have that input for us as individuals. So it's nice to see you online. I look forward to seeing you in person, all of you.
Yes, it's looking very empty next door at the moment, I'm afraid.
Yeah, we look forward to getting back to the office.
Yeah.
But thank you to all of you for joining us today. Our next webinar is next week on the 6th of May, and that's video content for social marketing. And we will post these slides and link to the recording as well.
Okay.
So thank you, everyone.
Thanks very much.
Have a good day.
Bye-bye.
Stay safe.
Bye.
Bye.